welcome everyone to the Pitcher Partners offices today for our federal and state budget briefings. And of course, welcome to those of you tuning in for the live simulcast over the web. We are recording this event, so we'll share it with those who are registered later on and aren't able to make the live event, so they can choose to watch a delayed telecast if they choose. I'm Stuart Dell, partner at Pitcher Partners, and we are delighted to be hosting you this afternoon to introduce and interrogate on your behalf our key speakers who will be providing the briefing. Before we start, I'd like to take a moment to acknowledge the Wurundjeri people of the Kulin Nation, who are the traditional owners and ongoing custodians of the land on which we all meet today, and pay my respects to their elders, past, present, and emerging. Well, we made a decision ahead of this year's event to take advantage of the fact that we had a double header of blockbuster budgets in the nation over the last 2 weeks. Firstly, the Victorian government's state budget, which was delivered last week, and of course, the federal government's budget last night. That decision was for us to provide you with a briefing today on key measures coming out of both budgets, and I'm very glad we did. Neither budget had a raft of measures that is going to make your brain explode. It's manageable amount to get through doing both of them in today's session, which is great. And importantly, we have 3 of the best speakers in town to provide you with the greatest insights and analysis of what was covered in each of them. So what, if any, are the parallels in the budget positions that Jim Chalmers and Tim Pallas are each trying to navigate? On the one hand, we've got a state treasurer who's been introducing and increasing state taxes and spending like nobody's business over recent years, but predicting to return to surplus in 2025-26. The marketing headline on the state budget papers was helping families. On the other hand, we've a federal treasurer enjoying a better than expected surge in recent tax revenues, forecasting to achieve a surplus of $9 billion this financial year and use that as a launching pad to spend like nobody's business, except perhaps if in relative terms that nobody is Victoria. And we're forecast to go into federal budget deficits for the next decade. The marketing headline used there for the budget document was cost of living help and a future made in Australia. What is apparent, I think, is that with the current focus at both the state and federal level on cost of living relief, that there was no cost of doing business relief in either of this year's budgets. And I'm sure our speakers will talk a bit about that in their presentations today. On the quirky side of things, some of you might have seen one of the specific announcements last night of a 1% reduction in the agricultural levy imposed on sweet potatoes, a move that apparently has supporters of ordinary potatoes so angry that they're at boiling point. Potatoes, boiling point. In all seriousness, I understand it's been a very, very divisive issue, causing a giant wedge between advocates for those different types of potatoes. Sorry, you didn't know you were going to get comedy here today as well. On to the serious stuff. Of course, for a more in-depth analysis of today's announcements and their impact, it's time to hear from the experts we have joining for us today. Firstly, we'll have Catherine Birch to share with us her take on the budgets and what the announcements mean for our nation's economy. A senior economist in the Australian economics team at ANZ, Catherine will be able to share insights concerning the labour market, business and infrastructure and investment, and the broader Australia and Victorian economies. Prior to joining ANZ, Catherine worked as a senior policy advisor, economist for the Victorian government, an environmental economist for the Namibia Nature Foundation, and an economic analyst for BIS Oxford Economics. Her experience with the bank and as a former advisor in state government will certainly offer an insightful budget lens for us today. Catherine will be joining us by live video today. Unfortunately, she has this thing called COVID and has done us all the favour of not passing it on for those in the room. We really appreciate you still being able to join us today, Catherine, and we'll beam her in a moment. I think she can hear us. Following Catherine, we'll hear from Daniel Burt, a partner at Pitcher Partners Melbourne. He specialises in tax advisory with expertise in income tax matters for private and public companies and high net wealth individuals. He practices across a range of industries, including including property and construction, manufacturing and professional services. Daniel will update us on what is and isn't changing as a result of the federal budget, and perhaps overlay some comments about the tax landscape more broadly. And joining Daniel will be Irina Tan, another partner in our tax advisory team who specialises in state taxes, including duty and land tax. A member of the Tax Institute's Victorian State Taxes Committee and a member of the Property Council of Australia's New South Wales Tax Committee, Irina specialises in advising clients within the property industry and will update us on what changes we can expect, in particular as a result of the Victorian State Tax Amendment Bill, which actually dropped during the day yesterday. That's the bill where we see all the devil in the detail of what was announced in the state budget. So we'll get some great insights from Irina. So with that, now it's my great pleasure to introduce our first speaker for today's event. We feel really fortunate that you could join us today, Catherine, and share with us what you see as the bigger economic impacts from the budgets. So please join Catherine to the screen.
Thank you very much for that kind introduction, Stuart. The worst timing as an economist to get COVID during budget week, but here we are, so we'll push on through. So I'll provide a bit of a macroeconomic context for both the federal and the Victorian budget as well. And then talk about, what it might mean for economic growth, inflation, rates, that sort of thing, all the big hard-hitting topics. So I might just lay the scene first. Look, federal budget last night, not a huge amount to surprise us. Budgets nowadays, a lot of it is flagged beforehand. I'll sort of drop the curtain a bit. Our head of Australian economics put a line in the draft note we did on the budget last night about in every budget there's always a surprise, and this time it's X. And he took that line out this time because it just wasn't all that surprising. Probably the biggest surprise for us was 25-26 for the federal budget. The net new spending was larger than we thought it was going to be by about $5 billion. For 24-25 though, it was pretty much in line with what we expected. So we're not changing our near-term economic, inflation or RBA forecasts on the back of this federal budget. We're still expecting that the RBA will start to cut rates from November, and we'll get only 3 rate cuts this cycle. So it's going to be quite a shallow easing cycle, we think. And a big reason for that is the change in the fiscal stance. And I'll talk a bit about that through this presentation. So we are expecting, households' incomes really have been squeezed quite significantly over the past couple of years. Rates are certainly contributing to that. You can see in the chart on the right, real household spending per capita has actually been going backwards for 5 quarters. But there's really 3 things that have been contributing to that squeeze on household incomes. We've got higher rates, and that dark blue line you can see in the chart on the right, that's interest paid as a share of workers' compensation. So that's taking an extra 5% out of incomes. But what's also been happening is income taxes have been rising as well, particularly due to bracket creep. So you can see that light blue line in the chart on the left, that's income tax as a share of workers' compensation. So that's also been taking an additional, say, 5% or so out of incomes. And then we've been seeing higher. So those are the 3 real drags that we've seen on the economy and on households in particular. But all those things look to be turning around this year. Inflation is now below wage growth. So we saw in the wage data today that real wages rose by 0.5% over the past year. Still quite low, but they're not falling any further. So we should see household purchasing power improve through this year. But secondly, we've got these tax cuts that will be coming from the 1st of July. And we're expecting that they will be equivalent to the broader economy of about 225 basis point rate cuts in themselves. And that should boost household spending by about 1.2 percentage points over that 24-25 financial year and reverse some of that rapid creep that we've seen. And then the third thing is that we do think that rate cuts are going to, well, first of all, the next move by the RBA will be a rate cut. And second of all, that they will start in November this year. We think that the RBA is going to want to wait a while to see how households respond to the improvement through this year, particularly on the tax cuts. One of the biggest questions we have at the moment is how much are consumers going to spend versus save of those tax cuts? And that's going to outlook and the outlook for businesses as well. And up until a couple of weeks ago, we thought, you know, they will save quite a bit, but they'll also spend quite a bit as well, and some of that will be funneled through into discretionary spending. But since then, we've seen Q1 inflation come in higher than expected. Quite a bit of media speculation around whether the RBA might actually hike next rather than cut. And we're seeing the effect on that in consumer confidence. The latest reading on the ANZ Roy Morgan measure was the lowest we've seen this year. That was before the budget, so it will be interesting to see what next week's reading says. So there's a scenario where households go, oh, potentially there's more rate hikes coming, maybe we aren't past the worst. And in that case, we might see households actually save more of those tax cuts than we've factored in. That could mean that actually we don't see economic activity start to pick up as we would expect it to do in the second half of this year. But there are certainly risks that rate cuts don't come until 2025 as well. And one of the biggest, I guess, potential reasons for that might be that inflation story. So we have seen significant disinflation. We're back down to 3.6% on the headline, 8% peak in late 2022. But we need to look at the detail as to why that's happening. And the biggest reason for that disinflation is, by disinflation I mean the slowdown in inflation, is tradables inflation. You can see the chart on the left, the light blue line is tradables inflation. And this reflects things like food, clothing and footwear, household goods, electronics. Generally, we trade with the rest of the world, whether it's export or import. And a lot of the prices for these things are not driven by what's going on in Australia. They're driven by global supply chains, global economies, commodity prices, that sort of thing. The RBA doesn't have over. And you can see over history that tradables inflation is really quite volatile. We can't depend on it coming down forever. What the RBA is more concerned about is that non-tradables inflation and services inflation as well, which are the dark blue lines on these charts. And you can see that non-tradables inflation is still sitting at 5%. And this reflects things like rent, haircuts, domestic holidays, childcare, health, education, going to a restaurant, these sorts of things. So they're much more driven by what's going on with demand and supply in Australia, what's going on with labour markets, wages, domestic policy settings, including fiscal settings. And you can see that that's still running too high for overall inflation to be consistent with the RBA's 2 to 3% target. We think the RBA will need to see at least 2 quarters of lower non-tradables and services to be convinced that overall inflation, whether it's headline or trim mean, will not only return to their 2 to 3% target band, but actually stay there as well. It would be a really bad scenario if inflation comes back to target, RBA starts cutting, and then tradables inflation starts to pick up because of what's going on overseas, and inflation comes out of the band again, and the RBA potentially has to turn around and start hiking again. That's not a good scenario. So look, we are expecting that by Q3, we will see inflation slow down enough for the RBA to start cutting in November. We'll get the Q3 CPI data in late October, just before that meeting. But the areas that I'm looking at quite closely that present risks of inflation remaining stickier than it might otherwise be. 2 things really. market and the labour market as well. You can see on this chart, rent is rising quite significantly, almost 8% over the year. And that dark blue line in the chart on the left, that's advertised rent versus the CPI measure of rent. And that leads it by about a year. And that's telling me that it's not coming down anytime soon. And the chart on the right is the big reason for that. Rental vacancy rates are incredibly low and are unlikely to rise materially anytime soon. Now, there are both demand and supply side drivers of this. A lot of people point to migration, but as you can see from the rental vacancy rate data, we already had a very tight housing market even before the international borders reopened. And a big reason for that was, particularly in Melbourne, during lockdowns or after lockdowns, we decided that we didn't want to live with anyone anymore. So the average number of people per household declined by about 0.1. Doesn't sound like much, but you multiply that across every household in Australia, and it was estimated to boost demand for housing by about 140,000 homes. Very significant when you've got next to no population growth. And then we had the borders reopen and immigration recover very strongly. So actually, Australia-wide, the population is now larger than it would have been if we didn't have the pandemic. Now that blows my mind when I think about where we were a couple of years ago. That's not the case for Victoria. In Victoria, the population is still quite a bit below where it would have been on pre-pandemic trends. But population growth in Victoria is among the strongest in the country. On the supply side, we have obviously still got some constraints in terms of skilled labour. We saw some attempts in the budget to address that, but none of them really, for me, seem like materially. We've also got, insolvencies running higher in the construction sector. But one of the biggest reasons is that input costs have gone up more than prices. And so in many cases, the incentives for developers to actually build aren't there. You can also add to that some of the tax changes we've seen in Victoria, but I won't comment too much on that. And I guess the other thing to consider is that the residential, and this is certainly relevant in Victoria, but not only Victoria, most of the country, is that the residential sector is going to compete against this very large infrastructure pipeline that we have. And I'll talk a bit about that later. So that suggests to me that the supply side is not going to improve materially anytime soon, despite that 1.2 million target that the federal government has. The other area that I'm watching quite closely is the labour market as well. We do have a structurally tighter labour market now. Indicators suggest that we're only going to see unemployment gradually rise. Now, that is very good for households and workers and generally for the resilience of the economy. But it does suggest, particularly in a sector like construction, where we want to do a lot more, both on the housing and infrastructure side, that there are going to be constraints there. And we are seeing stronger wage growth now than we were, 1 or 2 years ago. We actually got the wage data for Q1 this year out today. It was a bit weaker than expected, but still running at above 4%. And it's unlikely to decline significantly or sharply anytime soon, particularly because if you look at the chart on the left, there's still a lot of people who have been on the same EBA for the past few years who haven't seen larger wage increases to reflect the higher inflation, tighter labour market environment, and so who will be rolling onto new EBAs over coming quarters. So that will mean that wage growth will be a bit more elevated than it might otherwise. The RBA is a little concerned, I guess a little bit more concerned about wage growth now and the wage inflation dynamic, particularly because we're hedging a lot of bets on productivity picking up. And you can see, excuse me, productivity has picked up for a couple of quarters now. But look, I'm sceptical that we're really going to see it pick up enough for wage growth of 4% to be compatible with inflation within the 2 to 3% target band of the RBA. So productivity is something that we're going to be watching very closely over coming quarters in particular. Just quickly on the business sector before I move to government, I guess, we have talked about how the household sector has been hit quite hard, dwelling investment as well, but it's investment and the government spending side that has kept, as well as population growth, that has kept the economy, I guess, more resilient than it would be otherwise. And we're still seeing domestic demand growth as positive, so domestic demand is still rising, just at a slower pace than it was. That's what the RBA wants to achieve, but it's probably not slowing as much as they might have expected. Now, in the business sector, you hear a lot of stories both ways. I'm sure that a lot of you would have very interesting anecdotes that I'd love to hear if I was there. But we're seeing things like higher insolvencies. You can see the chart on the left. But then on some other measures, capacity utilisation is still running quite high. And we're actually seeing business investment plans still being really solid. So the chart on the right shows that for the non-mining sector, capital expenditure plans are expected to be 12% higher than they were for the current financial year. Now that is nominal, so you've got to take out some inflation, but that's still a pretty large rise given the current environment. But I guess going back to what I was saying about rates, I was talking about how we're only expecting 3 rate cuts this cycle. So we're only expecting that the cash rate will get to 3.6% by mid next year and then hold there. So it will be more about reducing the restrictiveness of policy and moving back towards more neutral settings rather than actually having to stimulate the economy. Now, some of the basis for that, but the biggest change is that we now think that the neutral cash rate is a lot higher than it used to be. And the biggest reason for that, we think, is the change in the fiscal stance. So you think back to before the pandemic, and the government at the time was talking about getting back in black. And the RBA governor at the time, Phil Lowe, was saying, hey guys, could you maybe spend a bit more on infrastructure? You're taking money out and we're actually trying to stimulate the economy here and get inflation back up to target. Remember when inflation was below 2%? And we've also seen globally as well, post GFC, a lot of focus on fiscal repair, austerity measures in several countries. Now that stance has really shifted, and we've seen, I guess, potentially more public acceptance of larger public debt as well that we saw during COVID when we found out how effective public spending could actually be. So in the budget last night, yes, we have a second consecutive surplus for 23-24, the first time that's happened since the GFC. But you look on the left shows that we've got these structural deficits stretching out into the medium term. And you can see the chart on the right. It's those pesky payments being higher than revenue. So it's really an interesting time where we've got a lot of these policy spending areas, whether it's health, aged care, NDIS, defence, interest costs as well, all putting all this pressure on the budget, hard to sort of reel back in. So we've got these structural deficits happening at a time where, in the Australian economy, demand still seems to be running a bit ahead of supply, and we do have an unemployment rate below 4%. Usually in those circumstances, you would expect, plans for surpluses stretching forward as the fiscal policy tries to take some more money out of the economy to reduce that heat. We're just not seeing that now. And I guess the thing to be clear on is that this is not just an Australian trend. This is happening globally as well. So take the example of the US. Chart on the left, US budget balance. They're projecting budget deficits running from 5 to 7% out into the medium term as well over the next 15 years or so, during a period where, again, unemployment is below 4% over there. Their real GDP per capita is still rising when most other countries are falling. And we've got large programs like the Inflation Reduction Act over there, as well as some of these structural pressures too. So again, it's that shift from usually during these economic circumstances, we'd see government surpluses and governments taking money out of the economy. This time, we've got tight economies, tight labour markets, and governments are injecting more money into it. And it's not just those spending pressures, the operational side as well. It's obviously that investment side too. And so we are seeing net debt increasing. And you can see the chart on the right. This is for the different states, although we've only got the updated 24-25 budgets for Victoria and WA so far. But you can see for Victoria, we're expecting that net debt is going to continue to, well, they're expecting net debt will continue to rise over the next few years before potentially peaking. Just a note, you may think these stats are a bit different from some of the ones you've seen in the media. We use, when we're looking at net debt, non-financial public sector. So that includes some of the non-financial public corporations, water and transport and things like that. But a lot of this is really going to this very large infrastructure pipeline that we have. You can see, 22, 23, the last date that we've got actual data for. Look, even at this level of infrastructure spending, we're really struggling to do it. Demand is here, supply is here, and what do we get from that? We get these cost blowouts, which, the Victorian government is quite familiar with. Not only Victorian, I shouldn't be unfair, most governments across the country are experiencing these as well. But demand is up here for infrastructure, supply is down here, and we're planning for demand to ramp up like this. That makes it really hard for supply to catch up and suggests that those cost pressures are going to remain elevated. And a lot of the infrastructure sectors we're expecting to ramp up are public sector backed to some degree. So we've got the road and rail projects in particular at the moment, Melbourne and Sydney, where a lot of those are concentrated. But we've also got energy transition projects as well that are ramping up. And we've got things like defence investment too. So, if you think about the energy transition, the states and federal government have set emissions reduction targets and other targets as well. You need to actually build that out if you're going to get anywhere close to them. And then on defence, more at the federal level, we are seeing that lift as well, not just in Australia, obviously, but globally, given heightened geopolitical tensions. So it seems unlikely governments are going to step back from that as well. So put all that together, public sector-backed investment in transport, energy transition, defence. Globally, everyone is doing this at the same time. So we're all competing for this limited pool of skilled labour, materials, equipment. And when we're all competing for this limited pool and trying to do so much in a short amount of time, we're all competing against each other, and that's where cost pressures get pushed up. That suggests to me that inflation is going to be running at a higher rate than it was before, and therefore interest rates are also going to have to run at a higher rate. I'll leave it there and speak to you when I'm on the panel. Thanks, everyone.
That was great, Catherine. Insightful as always. Now, Daniel, I'd like to welcome you to the stage.
Thank you, Stu. Welcome everyone this evening to our session on federal budget. Stu's already introduced myself, but just quickly to recap. So Daniel Bird, I'm a tax partner here at Pitcher Partners and have been here for about 10 years. First time presenting on our federal budget, so it's great to be here presenting to you all on the budget that was handed down last night. A lot of people say that the federal budget is a bit like the grand final for tax advisors or the Melbourne Cup for tax advisors. Unfortunately, last night didn't have the same highs as Collingwood's win over Brisbane last year. And if last night was a Melbourne Cup, we will probably scratch the barrier. The last few budgets coming out of COVID, there haven't been very few specific tax measures, absent temporary full expensing and those sort of measures to stimulate businesses buying assets. Last night was very similar. There was a few press releases prior to last night, very few surprises that came out, and unfortunately very little in the way of measures for businesses, which we'll talk to shortly. Some very small, limited, targeted measures for businesses, but unfortunately not a lot there. In what is reminiscent of taking your kids to the Royal Melbourne Show and doing the carnival games where everyone wins a prize, last night all taxpayers got a prize. Everyone got a tax cut. Everyone's going to save $300 in their power bills. Whether that's a deliberate ploy by the government to keep all individual voters on side, whether there's an election coming, we'll see. But there seemed to be a deliberate ploy to keep as many people as possible happy with what was released last night. From a headline economics perspective, which both Stuart and Catherine have pointed to, expected surplus of $9 billion this year, and then flipping that next year for a deficit of almost $30 billion. So a lot of expenditure over the forward estimates period. So what are we going to talk about in the next 15 minutes or so? I'll give you a high-level overview of what was talked about last night, focusing on tax and some non-tax measures. Then we'll be talking about some of the key issues relevant for individuals, predominantly focusing on, what were the stage 3 tax cuts, but what individual tax rates and thresholds we'll be applying from 6 weeks' time. We'll talk about the limited measures that were announced that will impact on businesses, and then a couple of other measures that related to some certain tax changes, ATO resourcing, and a couple of other matters. So firstly, we get to essentially an overview, high-level overview of the budget. This is a quote that came out of Treasurer Jim Chalmers last night. In his words, a responsible budget for the here and now, and as a budget for the decades to come. As I mentioned, with an election next year, maybe early next year, it may have been an early pitch to voters not to put anybody offside. I did read, and I'm not claiming this quote for myself, I did read an economic commentator this morning who had an interesting take on the budget. He said, you can tell a government's true priorities from what it does in its budget. If so, the top priority of this government's budget is not to have any priorities. Whilst he was being obviously flippant and tongue-in-cheek, it is hard not to notice that, all taxpayers will get a tax cut, all taxpayers will get some savings, rather than being any sort of specific targeted structural measures that may impact on certain aspects of the economy more so than others. So what were the top 5 priorities that came out of last night's budget? The key one is helping with the cost of living. There are 4 or 5 other measures in relation to that cost of living, which we'll get to on the next slide, but that was a key focus of the government, and they're walking that tightrope and trying to help with the cost of living, whilst at the same time trying not to stimulate inflation. Secondly, building more homes for Australians. So a lot of money was committed to building more homes. Unfortunately, there's a real missed opportunity there in terms of the build-to-rent space. There has been some announcements around making build-to-rent more attractive. We were hoping that there might have been some more announcements in last night's budget, but sadly, there weren't. So given that building more homes is a key platform, it's disappointing not to see more reforms on the BTR space. The government's also looking to invest in what they're calling Future Made in Australia. We probably all remember the Made in Australia campaign from decades ago. We've now got Take 2, which is the Future Made in Australia. And that's focusing on sort of renewable energy and making Australia a renewable energy superpower. We've also got strengthening Medicare and the care economy, so aged care and the NDIS. And the 5th priority in the government's eyes was responsible economic management. So in terms of what are the cost of living relief measures, you'll sort of see that those are the top 5 there in a monetary sense, with the biggest one being tax cuts. And you can see that sort of dwarfs everything else in terms of what those key cost of living relief measures were. The tax cuts that are coming in from 1 July estimated to cost up to $25 billion a year. I'll talk to that in a couple of slides' time. We have also got power bill relief. So as I mentioned, every household will get a $300 energy rebate. Not means tested, so every household will get that, but that will cost $3.5 billion. There'll also be a 5-year freeze on medicines on the PBS. There will be a winding back of HECS debts, which we'll talk to on the next slide as well. So that will be favourable for students who have seen a ramp up in their HECS debts being indexed to inflation. And there's also some help there for renters. Maybe some assistance with stimulating BTR might have helped that, but I'm not going to keep flogging that horse tonight. So now, individuals. Key discussion point here is going to be, what are the tax rates, what are the tax thresholds, and what's changed? These are the thresholds you can see now that have applied, for the last couple of years and will apply for the next 6 weeks or so. And if I just click, you'll see that this is what we had been expecting up until January this year, when the ALP announced that they were going to wind back what were the stage 3 tax cuts. For a couple of years, many of us have been expecting that announcement, and it came in January this year, with some modifications to what was otherwise going to be legislated to be introduced from 1 July. So we can see here what the key differences are between what was going to be brought in through the Liberal policy and what the ALP have brought in. Now, we could debate for a long time whether it's a broken election promise and so forth, and I'm not going to shed any more time on that. The fact is, we've got these rates that are going to be kicking in from 6 weeks' time. The key differences between what we're expecting and what the ALP have introduced is a drop in what was the 19% tax rate down to a 16% tax rate. So individuals on 18,000 to 45,000 will be subject to that 16% tax rather than the 19% tax rate. And one of the other key changes, 30% tax rate will obviously kick in. It will be applicable from 45,000 up to 135,000, whereas previously that 30% tax rate was going to be applying up to $200,000. So what the structural change is more tax savings for more taxpayers rather than designed for higher income earners on $200,000 plus. And as they said in the budget last night, every taxpayer will get a tax cut. In terms of what it means for dollars and cents perspective, crunching the numbers and comparing the Liberal to the ALP policy, somebody earning $100,000 a year will get a tax cut of about $2,200, which was $800 more than what was going to be the case under the Liberal policy. And somebody earning $200,000 a year will get a tax cut of about $4,500, as opposed to a tax cut of $9,000 that they're going to get under the Liberal policy. So somebody over $200,000 is still getting a tax cut, $4,500, but that's half of what was expected. And so that's a key item that came out of, well, not just last night's budget, but also the announcement earlier in this year around changing those rates. And as Catherine said, well, the economy will see that's a lot of surplus cash going into people's pay packets. In terms of HECS, so many of us in the room probably have or had HECS debts at one stage, helped us go to university and fund university. Now, HECS traditionally has been indexed and 7-8% over the last year. Many students who are ramping up at their HECS debts. So the announcement last night, which was leaked pre-budget, is that the government is going to cap the indexing at the lower of the CPI and the wage price index. And relevantly, it's going to be backdated to mid-2023. So that's going to save students over about $3 billion in student debts. Now, that debt's only been recognised on the government's books for the last 6 or 12 months. They're not really winding back a debt that's been owed to them for very long, but it's helpful for students that that indexation has not just been wound back at the moment, but will be changed going forward. So it's the lower of those two indexes. Superannuation is a bit of a vexing issue at the moment. There's been a lot of structural changes and reform to super over the last 3 to 5 years, really reducing the incentives of having large balances of your wealth tied up in super. There was one main announcement last night, which is superannuation on government paid parental leave. So under this policy, the government's committed about $1 billion over 4 years to pay superannuation to those people on government paid parental leave. This will apply from 1 July 2025. And essentially eligible parents will receive an additional payment into their superannuation fund based on the SG rate, which when this becomes law, will be the SG rate of 12%. That was the main announcement from a superannuation perspective from last night's budget. There were also some minor references to a couple of superannuation initiatives, probably the wrong choice of words, but superannuation reform. The budget did reference payday super, and this is coming in from 1 July 2026 with some money committed towards implementing that regime. And also an announcement in relation to very controversial tax around this additional 15% tax on superannuation funds that have balances over $3 million. We've had separate sessions on that tax, and it's a departure from well-known principles that it's going to be a tax on unrealised capital growth. But the government did announce further funding towards the implementation of that regime. So that's unfortunately not going anywhere for the time being. In terms of business, we might skip business. No, only kidding. There's a few mentions in there, but not a lot. Really, there was the main item that will be relevant for small businesses is an extension to the instant asset write-off. We've had various iterations of this over the last 5 to 6 years, where the income threshold has changed, the asset cost threshold has changed. But what the government committed to last night was extending the instant asset write-off for a further 12 months so that it will apply from 1 July 24 through to 30 June 2025. It will apply only to small businesses, and so that's businesses with an aggregated turnover of $10 million or less, and will only apply to assets that cost $20,000 or less. That's on an asset-by-asset basis, but it's a threshold of $20,000. Now, that's similar, for those who were here 12 months ago, similar to what the government announced last year in bringing back the instant asset write-off for the current financial year. And what was announced last year was, again, a $10 million threshold and a $20,000 asset cost. However, watch out, as that hasn't actually been legislated, despite the fact we've got 6 weeks left to the end of this financial year. As that went through Parliament, there was debate over whether that turnover threshold should go from $10 million to $50 million. And that was based on feedback from the Greens and other parties, and also increasing the acquisition cost threshold to $30,000. So that's still not law. We've got 6 weeks left in the year to get some certainty on that. Not sure where that's going to head, but the government did commit last night for the next 12 months to have that instant asset write-off, but only at that $10 million threshold. So we'll see what happens over the next 6 weeks for the current financial year as to whether we're going to be having a $10 million or a $50 million threshold, and doesn't give any businesses any certainty in terms of buying capital assets and being able to essentially write those off when we've got 6 weeks left in the year, and we're not sure whether it's applying to businesses that turn over $10 million or $50 million. And there's a fair few businesses in that gap between the 10 million and 50 who have currently got no certainty. Some other announcements impacting businesses, but a smaller cross-section of the business community, and those being significant global entities or SGEs. An SGE is a business that turns over $1 billion globally, and that's on an aggregated basis, so taking into account all subsidiaries and so forth. But a couple of rules in relation to, and a couple of announcements in relation to intangible assets. A couple of years ago in the mini budget being when the Labor Party were brought in and did their own emergency small budget, they announced a particular integrity rule to prevent SGEs from claiming tax deductions for payments in relation to royalties and other intangibles made to parties in low tax or no tax jurisdictions. Now, a lot of time was spent drafting up legislation, and 2 years since, the government has decided to withdraw that legislation. Those rules are going to be discontinued, and that's largely because measures that are being introduced at a global level around the base erosion and profit shifting Pillar 2 initiatives will essentially take over what was going to be achieved by those rules. Under BEPS Pillar 2, there'll be a domestic minimum 15% tax where multinational groups, regardless of where they earn their income, will need to pay a minimum tax of 15% in each country. So those rules will essentially overtake what was intended with this previous integrity rule. There's also going to be a new rule in relation to what's been referred to as embedded royalties. And so this can apply where there are payments which might be for services or for goods, but the payment actually has a royalty component embedded in that. And that's to counter arrangements that are trying to circumvent or reduce a liability for royalty withholding tax. This is in response to a recent case in the federal court in PepsiCo, where Schweppes Australia was buying syrup and product from Pepsi in the USA, and were able to use their branding and were paying them just for the syrup. And the court found that no part of those payments included a royalty for the use and license of the Pepsi brand. So whilst they're only paying for the syrup, there was an embedded royalty in those payments. And so these rules are going to be essentially introduced in response to that. Quickly on a couple of other measures. This is probably one that we weren't expecting in terms of the tax team expecting this announcement last night. For some time, we've had essentially a foreign resident CGT exemption in Australia. The only exception to the foreign resident CGT exemption is assets, which we refer to as taxable Australian property. In its normal sense, traditional sense, taxable Australian property is land or an interest in land. So where a foreign resident sells land or a lease over land, that is still taxable, even though they're a non-resident selling the asset. Another key category of taxable Australian property is shares in a company or units in a trust that predominantly holds land. And when I say predominantly holds land, the test is the market value of the land and real property owned in that company at least 50% of the value of the market value of all gross assets. Now, the announcements last night is there going to be some amendments to this foreign resident CGT to clarify and broaden the type of assets. So currently it applies to land and leases and certain mining and prospecting rights. Whilst the detail is limited, we expect it might be extended to things like water rights and air rights. We will wait for the policy and the detail to be released. Another change is that the test time for when a foreign company is selling shares in an Australian company, the test time traditionally has been the date of the contract, the date of the CGT event. And so the date that the contract is signed, you compare the market value of your land assets to the market value of all your assets. And if that's less than 50%, then there's no tax to pay. If it's more than 50%, then there is tax to pay. The announcement last night is that rather than moving from a point of time testing to actually testing over a 365-day period. And that could mean that if you fail that test in one day of those 365 days, that the sale will be subject to capital gains tax. Now, practically, does that mean businesses need to value all their assets? Given this is a market value test, do you have to value all your assets every day? Value your trading stock, value your goodwill, value your land and buildings to work out whether you're under or over that 50% every day? And if that's the case, then the biggest winners from last night's budget are the valuers, because they are going to be very busy valuing assets on a daily basis. Hopefully some common sense prevails in terms of what will have to be satisfied, but it's moving away from just doing a point in time test to testing over a 12-month period. Finally, there's going to be a notification. So where a foreign resident sells shares in an Australian company and the price is more than $20 million, they'll need to notify the ATO before the sale occurs. And that will likely then trigger some follow-up questions from the ATO and maybe some assessing and reviewing this principal asset test to see whether it's subject to tax or tax-free. There were some other new measures which were really tied into the Made Australia initiative and trying to have Australia as a renewable energy sort of superpower. There's some really large numbers here in terms of the funding to this. And whilst it may only apply to a limited, niche businesses, those who are in, critical minerals or hydrogen production, it's forecasting between those two measures almost $14 billion of tax incentives over a 10 to 12 year period. So whilst it may not impact many in the room, it's a fairly substantial budget commitment and tax incentive that's going to apply for those two measures. Finally, there's some tweaks to the producer, so film producer tax offsets. against some minimal changes there to make that more attractive and available to more filmmakers, TV makers, to really encourage more investment in that sector. Finally, what has been a key feature and a common feature from recent budgets is ATO funding. And last night was no different. The government has essentially extended two key compliance programs, that being the Tax Avoidance Task Force, which has been around for a few years, but the government has recommitted for 2 further years. They're expecting receipts of over $2 billion, payments, albeit to the staff that they have hired over the last few years, including $1.2 billion. So clear they're expecting a return from their investment by extending that a further 2 years. There are also, 2 other ATO compliance programs, being an extension of the personal income compliance program, looking at work-related deductions, short-term rental properties, things like that, and also extending the ATO shadow economy. And finally, the ATO are committing some money to a counter-fraud strategy aimed at preventing loss from fraud and cybercrime in the tax and superannuation systems. What does all that mean? It really means that the ATO is still going to be very, very busy in reviewing private groups, public groups, wealth individuals. We've seen firsthand that ATO activity increase over the last 3 or 4 years, and with these extra funding commitments, that's not going to go away. So, key takeaways. You can see them on the screen there. We've got cost of living relief for all taxpayers, and it will be all taxpayers through tax cuts and the energy rebates. For businesses, limited support for businesses, really only small businesses and a couple of niche businesses. And I think what was really lacking is any real structural reform to tax, structural incentives, whether it is property in the build to rent space, whether more incentives for business, tweaking GST or other income tax initiatives. It was sorely lacking from last night's budget. So with all that in mind, I look forward to your questions later on the federal budget, but for now I'll pass over to Arena Tan, who will talk to you about last week's Victorian state budget.
Thank you, Daniel, and good afternoon, everyone. Thanks for coming along. As Stuart mentioned, we've got the bonus of having the state budget being covered in this event, which I'm pleased to participate in. And I recognize that many of you would have seen or heard or read the coverage from last week's budget. But before I talk to the taxation aspects, I thought it might be worthwhile to jog your memories in relation to some of the numbers that you might have seen or read about last week. So in terms of the expected revenue and expenditure for 24-25, as Catherine or Stuart might have mentioned at the start of this event, we're expecting a $2.2 billion deficit. And according to the budget materials, we'll get out of deficit into a $1.5 billion surplus position, which is driven through an increase in revenue by $5 billion, $2 billion to come from taxation revenue, and expenses are forecast to increase by $1.3 billion. In relation to net debt, Catherine mentioned that some of the figures on her slides might differ from what I have on the slide here, as well as what you may have read already last week. But as you can see there, for 24-25, the main numbers there are an interest expense of $6.5 billion, which is 24.4% of GSP, and that amount is going to increase or balloon to 25.1%, and with that number that kept being shown last week, which is that daily interest will get to $25.8 million, which is pretty significant. Now, not to labor the point, but I thought it might be worthwhile looking at what the numbers were 10 years ago. And 10 years ago happened to be when the Labor government got in. But back then, as you can see, net debt as a percentage of GSP was only 5.8%. And the numbers were significantly smaller 10 years ago. Same 10-year period, we have seen 53 new taxes or tax increases. So go figure. Now, in terms of total revenue, that's forecast to be $96 billion for 24-25. And of that amount, $39 billion will come from taxation revenue, which is around 41%. So that's pretty significant. And that is projected to increase to $45 billion in the forward estimates. So employers and landowners, and I'm sure this is no surprise to anyone in the room today, but employers and landowners continue to be the biggest contributors to both the taxation revenue as well as total revenue. So in terms of employers, they're expected to pay $11.1 billion in payroll tax, and that includes the COVID levy and the mental health levy. Landowners are expected to pay $7.8 billion in land tax, including the COVID levy, $8.5 billion in transfer duty, and $1.8 billion in other property taxes and levies, including the windfall gains tax, which I think are slightly undercooked in terms of the numbers in the budget papers. Now, before I get to the tax part, I just thought it might be worthwhile or interesting to point out what our budget analysis survey a short while ago. According to you, the top prioritized in the budget are a reform of state taxes, that's only 6%, reducing red tape for businesses, and lastly, measures to address challenges to housing supply and affordability. And of the respondents to that survey, 53% rated themselves as being very worried about the housing affordability issue in Victoria. Now, in terms of the tax measures coming out of this year's budget materials from last week, they're not very significant at all, but the first one is an increase to the waste levy from the 1st of July 2025, and that's just to follow New South Wales. The next one is a land tax exemption for social housing and emergency housing from the 2025 land tax year. And that will also extend to charity-owned land that is being developed for such housing as well. The third item there is in relation to the fire services property levy. So they've been collecting below the levels they're allowed to collect in the last few years because initiatives were funded by consolidated revenue. That won't happen anymore, so they're now going to collect to full levels. And lastly, they announced a $700 million boost to the home buyer fund, but that's sort of, little relief really, because the scheme will end in a year's time or so anyway, before they hand off to the federal government. So in terms of measures from the previous budget that's still to come, I thought it might be worthwhile reminding you that we've got the commercial and industrial property tax, which is coming into effect or will go live from the 1st of July. So as of last night, both houses of parliament actually passed the bill, so it's just now waiting for royal assent. Craig Watman and I will be presenting on this topic in 7 days' time, so I'm sure I'll see many of your faces again next week. And yeah, unfortunately, it's very little time for various landowners to adjust to it. And we were hoping that they'll push back the start date, but unfortunately, they're sticking with that 1 July 2024 start date. There's, of course, also the vacant residential land tax, which got a lot of media coverage already last year and has been a bugbear for many here. So it's a reminder that that is to start from 1st of Jan 2025 in terms of the 2025 land tax assessments. But remember, this is based on the use and occupation of properties this calendar year. So given we're in May, you really have got not much time to ensure that you have properties used and occupied for at least 6 months in this calendar year to avoid the VRLT liability next year. Third, there are also payroll tax changes announced last year, which might be a distant memory now, but some of them are to start from the 1st of July 2024. So the first one there is actually a good thing. It's an increase to the tax-free threshold to $900,000. Unfortunately, though, there'll also be a phasing out of the tax-free threshold for businesses with taxable wages above $3 million. The third one there is that payroll tax will start applying to certain schools that are not declared as exempt. Now, in terms of the bill that Stuart mentioned at the very start, that bill really got released to the public just last night. And as of perhaps 20 minutes ago, I've just seen the lower house, despite some robust debate from the opposition. And now this is awaiting debate in the upper house at the moment. But broadly, this legislation provides that for a number of things. The first one is in relation to the vacant residential land tax, which includes some changes in relation to holiday homes that we've all been keenly waiting on. But broadly, the legislation provides that the holiday can apply to land held in trusts and companies. Certain requirements are met. So I've listed just in summary there the requirements there, but we also have a QR code on the slide, which you can click into to our article that was published last night as well in relation to these changes. Pleasingly, the bill also allows for the VRLT exemption, the holiday house exemption, to apply to unimproved or undeveloped land that's contiguous to the holiday homeland. So that's actually great news for people who have two parcels of land and they have got the holiday house on one land and they've got the other land be a garden or a tennis court. Essentially, if you meet certain requirements, both could be exempt from the vacant residential land tax. I've already mentioned certain land tax exemptions for social and emergency housing, so I won't cover that in detail here, but there is also a technical amendment to address an anomaly that is in relation to deductions for certain jointly owned land as well as land owned by certain trusts, and that's really where you've got the two levels of assessment. Essentially, with the introduction of the fixed COVID levy surcharges, you could get hit twice without a perfect sort of deduction to allow for it. And this really depends on the value of land holdings, but essentially it's in relation to the $975 fixed surcharges. So technical amendments, but pretty minor in this grand scheme of things. Now, in relation to the other stuff coming out from that same bill, there's one in relation to business insurance duty as well as the Metropolitan Planning Levy, which are overall positive changes. There is one not so positive one in relation to the Growth Area Infrastructure Contribution, or GAIC, and that's really because they decided that enough is enough and they'll introduce an integrity measure that prevents certain private landowners and developers from minimizing GAIC, where they've excised certain parts of the land to authorities for roads and reserves. In terms of the key takeaways from this year's budget, similar to the federal one, little sort of cost of doing business relief, unfortunately, despite what you rated in the pre-budget surveys. Unfortunately, we've not seen that in this year's budget in Victoria. The other one too is we continue to be very deep in debt with a massive interest expense. So whilst this year's budget, we don't see really much sort of adverse tax changes, question about whether that will continue because they'll need to get the money from somewhere. And lastly, in terms of housing, in echoing what Daniel said earlier and others as well in the room, I'm sure you hold this view as well. There's been a lack of meaningful attempts at addressing housing issues. There is a real missed opportunity here in terms of addressing all these things, and one wonders how we will actually resolve this in the years to come. And that concludes my presentation, and happy to invite Stuart Dahl back to the stage.
Fantastic. Thanks, Irina. If you'd just like to take a seat, they're really comprehensive and informative as usual. I'd now like to welcome Catherine and Dan, if you'd like to join me on the stage as well for our Q&A section. We've had quite a few questions that have been submitted online and in the room. I might start with a question for you, Irina, and the question was, what sort of changes to the tax system in Victoria do you think are needed to promote investment in Victoria?
That was tax changes too? Yep. I think as a start, the windfall gains tax is something that hurts rather than helps the industry. It's a pretty ugly tax that is pretty uncertain until it's too late really to do much about it. So that's a key one from just a couple of years ago, which I keep hoping they'll get rid of, but unfortunately it's here to stay on the looks of it. The other one that I think will assist is if they relax the rigid rules or restrictions brought in relation to the off-the-plan concession. So if you think back, a few years back, not that long ago, even how the off-the-plan market was booming. There were lots of foreign investors also buying up apartments, getting access to the off-the-plan concession. Over time, the off-the-plan concession has tapered off significantly. And they've introduced the foreign surcharges as well for foreign investors, which is a double whammy that's seen the off-the-plan apartment market take a dive since then. So I really think that getting rid of the windfall gains tax, again, one can hope, reintroducing the expanded off-the-plan duty concession and perhaps lowering or getting rid of the stamp duty foreign surcharges altogether will go a really long way in encouraging investment in the residential market.
Okay, so that's the optimistic question that I'm asking you. The other question that's come in here as well is, while this Victorian budget did not include any significant new taxes, do you expect further significant taxes in the future? I think you mentioned 53 in the last 10 years has been introduced.
53. And I didn't sit down and do the counting. So it was the UDIA who actually looked back and counted 53. In terms of further taxes, I sincerely don't want to see more taxes. I think the property and industry in particular has taken a great hit already. But if you look at the numbers, including the net debt position, I think that sort of taxes are on the cards in the future. It's a matter of when and in what form or shape they'll take. So one can hope, but again, to be realistic, I can't see how they won't increase taxes or introduce new taxes, unfortunately.
I've got a question, Catherine Birch, for you on the screen there. One of the questions that's come in here is nearly 40% or $6 billion spend over the next 2 years in the federal budget, I believe, remains unannounced. Where do you think the government will likely spend some of this in the run-up to the election?
Look, I think some of that will be earmarked for future Made in Australia projects as well. So there's still quite a few details on that package that will come out in future months and future budgets as well. We know that really the focus this time has been on the cost of living relief. But there was, so the Treasurer mentioned something about this may not be the last budget before the election, which suggests that, that they might be quite close together, given the election will probably need to come by mid next year. But there does seem to be a bit of firepower that could be unleashed on certain areas that may be, from the government's point of view, beneficial going into an election.
Dan, I've got a question that's come in for you here. When are we going to get some proper tax reform, including increasing GST?
Excellent question, Stu. With an election on the cards next year, I can't see it happening next year. And I suspect meaningful reform may be for the foreseeable future in the two hard baskets. We've seen both sides of government sort of refuse to have meaningful tax reform over the last, feels like 5 or 6 years. The only two main initiatives that really come to light over that last period were all right through COVID, where we had JobKeeper and we had temporary full expensing and lost carryback. So very specific targeted measures to ride through COVID. But either side of that, I can't really recall too many structural reforms.
Well, that's not reform either, is it? That's
no.
reactionary. So you think even further back, people still go back to Ken Henry's paper that, I don't know what year that was. It seems like it was probably around 2010 or maybe even before. Someone would know.
Paper, then they changed colour papers again, but none of that saw the light of day. We've had a whole lot of tax reviews that haven't actually seen the light of day.
Perhaps another question for you or any of the panellists if they have a view as well. But a question that's come in here is, how do the future Made in Australia subsidies compare against the subsidies that have been made available in the US and the EU? I might start with you, Catherine.
Yeah, so I mean, to put it into perspective, we've got 22.7 billion Australian dollars allocated over the next decade for the future made in Australia. Now, there are varying estimates for the Inflation Reduction Act in the US, but they generally run to the hundreds of billions of US dollars over the next decade. And you can see some estimates that they're getting close to $1 trillion. Now, we don't know exactly what that would be, but we cannot compete with US industrial policy. I know that the Future Made in Australia is trying to be targeted into certain areas, whether it's critical minerals, hydrogen, associated manufacturing. But really, we're a bit of a pipsqueak in that industrial policy competition. And I guess the key thing, which is always hard, is making sure the money is going to the projects where we're actually going to get bang for buck, where we're actually going to get the productivity gains, and it's actually going to help with Australia getting through this transition.
Yeah, thanks, Catherine. I'm whizzing through these questions because there are a lot, so I'm sort of firing them at you guys as we go through. So there's another question that's coming here. Probably one, well, definitely one for you, Irina. The question here is, if I am buying a commercial property soon, do I have a choice of paying stamp duty or going into the annual surcharge system?
The answer depends on the timing. So if you're contracting to purchase before the 1st of July 2024, then it's the ordinary current rules that should apply, just stamp duty, nothing else. If it's after the 1st of July, you'll probably be looking at the stamp duty bill anyway, and in 10 years' time, if you still own the property, you'll start paying the annual property tax. So timing is the crucial differentiating factor here.
Timing is everything. So just on that same theme, do you think there'll be a removal of stamp duty and a replacement with an annual land tax for residential properties similar to what's commercial in industrial property?
My view is that unlikely to happen in Victoria. I think the state government has been too reliant on stamp duty for residential properties. I don't really see them, I guess, changing it anytime soon. I attended a breakfast with Tim Powers some time back where he was asked the same question, and his answer was pretty much not going to happen. But that being said, he's I think rumored to step down around Christmas. So who knows what the new treasurer might do? We'll need to wait and see. Interestingly, in New South Wales, they actually did do that for a very short while, abolish or provide at least a choice of paying stamp duty or an annual land tax to personal buyers, home buyers. And that was a very short-lived measure, I think, of just a few months. It fizzled out just as quickly as it came in.
Irina, is that a policy perspective, also a cash flow issue? It's probably easy for mums and dads who are borrow a bit more to understand duty, but then moving from that to an annual land tax equivalent then just impacts on your annual weekly cash flow that mums and dads may not otherwise be able to afford.
Yeah, no, I think that's definitely one of the many factors that sort of count towards that decision as to whether it can work the same way feasibly for residential properties.
Daniel, a question for you. You spoke about the instant asset write-off. I think it's about Mark 4 or Mark 5. You mentioned that it applies for businesses with a turnover of less than 10 million. Are there annual turnover of less than 10 million? Are there any watch-outs or carve-outs for this turnover requirement?
Yeah, that's a good question. We get that a similar question often, on a weekly basis in terms of what are the aggregation rules, what's in, what's out. The term is based on aggregated turnover. So as the name would suggest, it's not just that entity, that business in question. It also brings in turnover from connected entities and affiliated. So that's stopping you from having 10 different businesses that all derive $8 million of turnover to access those. So it is done on an aggregated basis. The other watch out is that not all revenue is taken into account. Aggregated turnover is only annual business turnover. So income from carrying on a business. So if you're deriving passive income, interest income, capital gains tax from the sale of investment properties or businesses or anything else, that sort of income is excluded from your aggregated turnover. So It's not just as simple as looking at your tax return and what you're looking at your financial statements and looking at your headline revenue. There are a number of exclusions and inclusions to those rules.
Catherine, a question for you, and I always am quite interested in this around some of the budget assumptions that sit in around the forecasts. And one of the key things is obviously around commodity prices, and in particular the price of iron ore. And it seems to me that it's consistently forecast to be much lower than the prevailing price at the time of the budget, or as it has been in the past. We seem to or the prices seem to outperform that overall. There might be some fluctuation in between, but that's the gift that keeps on giving in terms of top line revenue for the government around those commodity prices. Do you have any comments to make about the assumptions in this year's budget?
Not really. I mean, it is one of those areas, particularly over the last few years, but probably going forward, we'll continue to provide some upside risk to where the budget balance actually ends up compared with those projections. And we can see that in the parameter improvements that we've seen in the most recent financial year, 23-24, which was a big reason why we ended up seeing that $9.3 billion surplus versus the $1.1 billion deficit that was projected at MyEFO just in December. This is just what do you call it? I mean, it's just a standard assumption from Treasury. We have seen, I think recently, an assumption that it doesn't fall as far as it usually would. So that those plateau prices are higher than they used to be, but still generally quite a bit lower for a lot of those major economies than where they are now. It is to try to be a conservative approach. It is looking at those long run, levels, or closer to those long run levels. But it is really hard to see those commodity prices getting anywhere near those assumptions for most of them. So some upside risk there.
Got another question here, and I'll ask Irina first, but also throw it open to the others if you'd like to make a contribution or have got a view on it. The question here is, would introducing an off-the-plan duty concession for locals and foreigners provide a bang for buck for the government in productivity increases?
I think that's a really good question, and unfortunately with these things, it's hard to tell until it's been done and you look back and sort of look at the results of that. My view is that I think it should, and I refer back to my answers at the start about how relaxing the off-the-plan duty concession rules can help, improve the property and residential market and encourage investment in it by developers as well. So I think that's one of the easier ways, or the lower hanging fruit to basically tackle. They basically just need to revert to the rules we had once upon a time. That's not too difficult to do. So no new laws necessarily needed to be drafted from scratch. It's just sort of rolling it back to what we already had.
And I guess I would add one of the key platforms from the federal budget was increasing housing supply. So if our federal governments and our state governments can work hand in hand to do that, things like stamp duty off the plan concessions may stimulate and get projects that may not otherwise have had the capital and the funding off the ground. So we need all of our levels of government to work together to fix the housing crisis.
That's a great segue, Daniel, to a question that's come in here. And it's a very simple, short question. It says, so who will be building the additional new homes?
Any takers in the room?
Question I can throw it out to all of you, which is what type of policy change do you think is needed to drive sustainable productivity improvements? Might start with you, Catherine.
Yeah, I mean, look, I'll defer to the Productivity Commission on this. They published a 5-year productivity inquiry. I think it was last year, the latest one, where they have a long list of recommendations as to how Australia could improve its productivity. And usually we don't see too many of those taken up. But there's a number of key areas that they talk about. I think we've already talked a bit about the energy transition and making sure that it's least cost and we're getting the most bang for buck and the most gains in terms of returns, but also emissions reduction. Also, the digital space, there's a lot of potential productivity gains there. But look, I'm a bit skeptical, given that in Australia, we're quite bad at diffusing new technologies, new, AI, things like that, across the broader business sector. A lot of the bigger businesses or businesses in tech are very good at taking up these new technologies and reaping those gains, but we're quite bad at actually diffusing that across the broader business sector. And then I think finally, our economy is moving more and more towards services. Services are people, and if you want to have more productive people alongside more, capital investment, tech, that sort of thing, you need better health, including mental health, and you need better education and training as well, and making sure that education and training meets the jobs required. Look, there are some attempts in the budgets to try and boost that. We generally see that in every budget. More, TAFE places to try and get more people in construction, that sort of thing. But again, I really find it hard to see things changing productivity and the outlook in the near term.
And just on that, sorry, Dan, it looks like you've got a comment as well, but on that, the migration numbers, that's obviously an issue that's playing in here. So there was obviously, coming out of the pandemic, an enormous imperative to increase migration numbers, trying to get growth going again. But there's clearly a view now that it looks like things have gone a bit too hard or got a bit too loose on migration. But how do we get the balance right?
Was that a question for me?
Yeah.
So, look, we are starting to see signs that net migration will come down, but it will take some time. Look, net migration can actually be a real productivity boost, particularly because Australia generally gets in a lot of skilled migrants as well, who can actually help Australia's productivity overall. But yes, that balance is quite hard, and I guess one of the issues that I don't see changing anytime soon, and again, we saw some announcements on housing supply, but given the challenges, don't look likely to really shift the dial, because we've still got a lot of unfilled labour demand out there. So a lot of businesses still getting in skilled migrants from overseas. But if a skilled migrant can't find somewhere to live that's affordable and in commutable distance from the job they're supposed to be filling, we're going to still see that gap. We're not going to get people into the jobs and then boosting economic and productivity growth. So again, that's a challenge I don't see turning around anytime soon, and nothing in the budget convinces me that things are going to turn around quickly.
Really, really quickly, Dan, you were going to say something, and I'm sure you're going to say something very insightful.
All I was going to say, is that Catherine's answer was exceptional, certainly from a tax perspective. And as Irena touched on, with 53 new state taxes having been introduced over the last 10 years, we've got far too many inefficient taxes, which are putting a strain on productivity. Things like being able to move house efficiently to move to a new area for a new job. Stamp duty and the other taxes in place just don't facilitate that. It's not just a state taxes issue, it's also a federal taxes issue, but we have too many taxes that are getting in the way of efficient markets and productivity gains.
So thanks, Daniel. Thanks very much to our speakers and for participating in our Q&A today. It's a measure of their calibre to take what at first glance might seem like a couple of fairly underwhelming budgets in terms of volume of material, and provide us with some really deep insights into how they might play out in practice. So if you could join me in thanking our presenters in the usual way. Important to remember that budget forecasts are all predicated on a complex set of assumptions. Invariably, these will be concerned with fundamentals such as geopolitical events, growth, core commodity prices, as we mentioned before, and general trading conditions. And with elections over the next 12 months, like happening in the US, UK, and here in Australia in 12 months or so, things can change rapidly as government priorities evolve alongside the dynamic economic and geopolitical environment. Staying flexible, efficient and productive will be as important as ever for all our businesses in the times ahead. It's been great to see so many of you here this afternoon, and I hope you will stick around to mingle and enjoy some more drinks and snacks, which are just making their way in. Terrific. Thanks again for joining us, everyone. Have a great evening. Look forward to talking to you after.